Welcome to our second speaker on our AI program on May 11th. Our second speaker is Kevin T. Carter. He's founder and chief investment officer of EMQQ Global. His presentation is titled The Future of Emerging Markets and the Rise of Digital India. And I particularly wanted to do an emerging market program with all the confusion and after effects of our COVID and going to in-person Zoom meetings as opposed to in-person meetings. Kevin is founder of and chief investment officer of EEQM Global. He is personally considers himself an active value investor, and he has collaborated with Princeton economist and index legend Dr. Burton Malkiel for more than 20 years. Together, Malkiel and Carter founded e-investing in 1999, a pioneering firm in fractional share brokerage acquired by E-Trade in 2000, and Active Index Advisor, a pioneer in direct indexing that was also acquired. In 2006, their efforts turned to China and emerging markets, where they launched several China-focused ETFs on the New York Stock Exchange with Guggenheim Partners. And I'll mention one thing to Kevin. When my daughters went off to college a while ago, I gave them two things. One was a cloth bag of tools and a copy of Malkiel's book on Random Walk Down Wall Street, because I figured those were two things. I wanted them to have tools, and I wanted to have some investment tools. So that's what I gave them. So Kevin, you're up.
Okay, well, that's really a great story. So thanks. You're the perfect host for today's presentation. So yes, my name is Kevin Carter. I don't really live in the Silicon Valley, but I think the Silicon Valley is growing up towards Pleasanton and places like that. But I'm in Lafayette, California, in the East Bay. You probably know where it is, 15 miles east of San Francisco. And I've lived here my whole life, except for a few years off in college. Now, my business presently is focused on investing in emerging markets internet companies, the emerging markets internet sector. And there's 46 emerging markets, and our main strategy, which is the name of our company as well, that covers the entire emerging markets internet space. That's EMQQ. If you don't want China for any reason, we have FMQQ, and now we have an India-only fund, which we think is something investors ought to be interested in. So INQQ and India have become a bigger focus in our business in the last couple of years, and I'll show you why. So just to get back to the beginning and to this book, I know at least one of you has read it. I assume that many of you have. If you've read it, you probably remember that this book is famous because in the first edition, the guy that wrote it, Burt Malkiel, suggested that somebody make an index fund. In 1973, when he published this the first time, there was no such thing as an index fund. And on page 226, you can see he laid out exactly what it should do and be, including a not-for-profit, which he suggested that and he suggested the New York Stock Exchange consider doing this. Apparently, according to him, they were looking at it, but they decided not to do it. But as he had hoped, somebody else did do it, his friend John Bogle. So this guy and this book are all about indexing. And people probably don't know that Burton, in addition to setting the stage for indexing to exist, he also was the chairman of the group that launched the first ETF, the Spider. So not just indexing and index funds, but ETFs as well. Now, when I started here 30 years ago, I had one interview in downtown San Francisco at Robertson Stephens and Company, which some of you may remember was the leading Silicon Valley investment bank. In fact, Mr. Robertson introduced Kleiner to Perkins, if you know those names. So it was kind of the OG, as we say, of the technology investment banking business. And My interview was 20 minutes long. We talked about college basketball, and then the guy said, "You can start Monday." And I said, "Well, I don't know anything. How can I start Monday?" My dad did not hand me a random walk down Wall Street when I left to college. So I came back and they told me to go buy it over the weekend. So I guess I did read it before I started, but it was kind of a last minute thing, quite literally. Now that I think about it in contrast to Lynn. But nonetheless, I went and bought this book at the bookstore in Walnut Creek, B. Dalton, Broadway Plaza, and I went back to Danville to my parents' house for the weekend, and I read the book, and I showed up Monday morning. Now, I very quickly realized that when it comes to investing, I'm an Omaha person, and when I think about any business decision or any investment decision, I have my best version of Charlie Munger lenses on. So that's how I think about the world. But I won't go into the details, but in 1998, during the dot-com bubble, I reached out to this man because something happened that was right out of his book. And we ended up having a nice dialogue. And then a year later, when I decided I wanted to save the world myself, I asked him if he wanted to be involved. And I had this idea that the world needed fractional share brokerage because back then, as I'm sure many of you know, if you wanted to invest in the stock market in 1999, the cheapest commission was $29 from Charles Schwab. And the average stock was about $30 a share. And if you wanted to buy a round lot, which is what the $30, the $29.99 trade, you had to buy 100 shares. If you bought anything different, you had to pay a bigger commission. And so $30 a share on average for a stock times 100 shares, that means you needed $3,000 to invest in the stock market. And so the problem was most people didn't have that at a regular basis to invest systematically. And so everybody had to use open-end mutual funds. And I had made a decent amount of money as an analyst providing research for open-end mutual funds, but I could see that the business was much more designed for the fund managers than for the end investors. And so anyhow, I concocted this idea to trade stocks in dollar amounts, found a good lawyer and good brokerage operations people to figure out how to build it, filed a patent, and built the thing and sold it to E-Trade in the year 2000. That was E-Investing. And Burton, again, was an advisor. Now, Burton and I went back to the workbench and got out our own bag of tools and decided that we could probably do something else, especially if we had this fractional share brokerage, which was people could make their own personalized index funds. And if they wanted to leave out tobacco or alcohol, they could do that. But they could also do tax loss harvesting. And if you own General Motors and it went down, you could sell it and buy Ford and create a loss. And at the end of the year, you could beat the market. And that was the theory. People said it was crazy, just like they did fractional shares. And now this has gone mainstream. You can get it at Schwab and other places. Now it's gotten different names. Some people call it personal indexing. The industry calls it direct indexing, which drives me crazy because it's our original name was active indexing. And so we sold the company to Natixis Asset Management in 2004. And then something happened. Just before we sold the company, Google went public. And when Google went public, they asked my partner Burton to give a talk about investing. Now, I wasn't invited, but Burton was on the West Coast and we had dinner the night before. And then him and Bill Sharp did a talk down in Mountain View for the Google employees before their company went public. And a few months later, a guy from Google called me. He must have Googled me, and he called and said, "Hey, I want to make my own custom S&P 500 fund. How do I invest with you?" And I said, "Well, we only work with advisors at Credit Suisse and Deutsche Bank and Morgan Stanley. And do you have an advisor?" He said, "No, and I don't want one." He said, "That guy's just going to add a fee, and I know what I want to buy, so why don't I just buy it straight from you?" And I said, "Well, all right, let me come meet you." And so I drove down to Mountain View one day in the first quarter of 2005, and I sat down with this kid. I was only a kid, but he was more of a kid than me. And explained what we did and how we'd use 100 stocks to track the S&P, and he could customize it and so forth. And he then said, all right, well, how much should I put in this strategy? And I said, I don't know. Well, how much money do you have? And he told me he had a very large amount of money. And I said, well, that's good. So you're rich, so you should be conservative. But you're 25, so you should be aggressive. And I said, I don't have a pie chart with me, but it's probably 20 or 25%. And he said, what about the rest of my money? And I said, well, we don't do the rest of your money. And he said, what would you do? And I said, I would just use a bunch of ETFs for all of the other asset classes, whatever we decide your pie chart should be. And he said, well, can you do that for me? And I said, I guess. So all of a sudden in 2005, my side job is an advisor to this Google person. And then he starts introducing me to other Google people. And so all of a sudden in 2005, every week I'm driving down to Mountain View, I'm sure some of you live in Mountain View, and going to Google and having lunch or otherwise meeting some engineer. And by the way, the first guy, when I asked him if he wanted to leave out alcohol or tobacco or firearms, he said, I never want to own Microsoft. So everybody has a different definition of ESG, as it turns out. And then when I asked him what he wanted to do with his life, he said, the first time I ever heard this, artificial intelligence. So, and if you misspell a word in Google and it says, did you mean? Well, he wrote that. So I think that was the first versions of AI. So anyhow, I start going to Mountain View in 2005 every week, but my partner Burton starts going to China. A couple of his Princeton buddies, Chinese economists, had been offered a lot of money to go back and teach in Beijing right around the year 2000, and they had been calling Burton and pestering him to come visit. And they said, Burton, you need to come see what's happening. We are capitalists. This place is booming. China was growing at 11% at that point. I think it put up even some 12 and 13% numbers along the way, but it was really booming. And he went and saw it. And he came back, and his two friends wrote a white paper about investing in China. And the Google guys called me and said, can Burton come talk about China? And I said, okay. And little did I know, when I picked up Burton down by San Francisco airport and drove to Mountain View, that 2 hours later, my life would take a sharp turn. And all of a sudden, I'd become immersed in China and emerging markets and trying to figure out what in the world does that mean to invest in China. So that's how I got here. Now, let me tell you what I learned in the 18 and a plus years since that day. So first of all, what are emerging markets? Where are these places? If you want to think about it simply, it's in terms of population, it's about, and in terms of economy, economic size, stock market size, all of these, generally speaking, 60% Asia, with China and India being the biggest part. It's about 15% Latin America, with Brazil and Mexico, about 70% of that. And then in the dark gray, you'll see that the other category is all over the place, from South Africa to Morocco, Poland, Kazakhstan. So this is what it looks like on a map. In terms of the populations, it's basically three different groups. You've got 1/3 in China, 1/3 in India, and 1/3 in the other category. Now, why are emerging markets intriguing to investors? What's the case for these places? It's pretty much been the same since I got involved, and it's pretty straightforward. This is where all the people are, and they're younger, they have better demographics, their economies are growing faster, and that's driving a boom in consumption. And that is the story still, and most of it isn't really debatable. It has 85% of the world's people. They're younger than we are, and thus are almost 90% of the future. Not only are their economies growing faster, they're now a lot bigger than the developed world economies. And the punchline is that it's driving a boom in consumption. And it's not just a boom, it's McKinsey calls it the biggest growth opportunity in the history of capitalism. So that's a pretty bold statement. It's not my statement, but even if they're wrong, it's a big deal. You've got 6.5 billion people and they want all the stuff we have. They want more food, better food. They want better clothing. They want an air conditioner and a heater. They want to go to a movie, take a vacation, get on an airplane for the first time, get a motorized vehicle, and they want their kids to go to Harvard or Stanford. And that's the story. I didn't have to figure this out. It's been well documented for a long, long time. So this is what I've been focused on, and it is the basis for everything we do at EMQQ. Now, here's the other main thing you need to know about emerging markets, because a lot of people say, yeah, emerging markets sound great, but nobody's made any money. I bought the Vanguard Emerging Market Fund. I bought the iShares Emerging Markets ETF. I haven't made any money. Well, there's a problem, and it's the index itself. And I learned this on my very first day. In fact, before I even sat back down at my desk, because after lunch, we drove back to San Francisco. 388 Market Street, went up to our floor, walked in the office, walked straight over to our portfolio managers, and I said, the Google guys want to invest in China. Give me a list of all of the companies in the China ETF. Because there was only one China ETF on the planet that day. It was managed by a company across the street that I could see out the window called Barclays, now BlackRock's iShares. And they had a ticker symbol FXI, which was the FTSE Xinhua China ETF from iShares. And so I asked for a list of all of the companies in that ETF because I'm an Omaha person. I don't care what the name of the fund is. I want to see what are the businesses we're going to own. And that's when Burton pulled me aside and explained to me that most of the companies were Chinese Communist Party controlled banks and Chinese Communist controlled oil companies. And that didn't sound very good to me at all. But then he started giving me an explanation of how these companies worked. And this list is putting it quite mildly. The conflicts, the inefficiencies, poor corporate governance. These companies are a mess. And the most important thing is they're not trying to grow their earnings. Nobody shows up at an SOE on Monday morning and says, how do we maximize the shareholders in the United States of our state-owned oil company? They're more likely interested in how they can steal money from the company. Now, the China ETF was 80% state-owned enterprises, right? 80% state-owned enterprises, and it was less than 10% in the real story. Now, before, and I hadn't even sat down at my desk yet, I'm like, well, we have a problem, right? Like, this doesn't match. You're telling me these companies aren't trying to grow their profits, and that's, the reason any business has value is because it makes profits for the owners. And the only way to grow the value is to grow the earnings. And if these companies aren't trying to do that, why would you invest in them at all? And you don't have to look far to see this problem. Petrobras in Brazil, the best example, half their Congress people, two of the presidents, all of them systematically stealing 5% from every contract that they did at the state-owned oil giant. Now, a lot of those people went to jail, including the two of the presidents that were part of this scheme known as Operation Car Wash. So the other problem with the index, by the way, is the internet companies aren't involved. So after I got the list, 18 years ago, I got the lecture about state-owned enterprises, and they gave me the list of all the holdings in the China ETF. Sure enough, I saw the China policy banks, the oil companies, but I got to the bottom. I said, where's Baidu? Because Baidu wasn't in the China ETF. Now, most of you probably know Baidu is the Google of China, and it was actually public before Google was. And for some reason, it wasn't in the China ETF. So we called the guys across the street and said, hey, we're thinking about putting some money in your China ETF. Where's Baidu? They said, well, we don't own Baidu. Well, I said, I can see that. Why don't you own Baidu? They said, well, we don't consider it a Chinese company. And I said, what do you mean that you don't consider it a Chinese company? It's the Google of China. And a 25-year-old kid at the real Google just gave me $100 million. So maybe it's good to be the Google. And they said, well, it trades on the NASDAQ in the United States, so we don't consider it Chinese. I said, well, that's the stupidest thing I've ever heard. And so not only is the index full of this, it's missing most of this. Now, they finally fixed this a little bit, but it's a problem. Most of the internet companies still are not included. Now, why is this whole thing a problem? Well, look, if you went back 15 years, China's economy has grown 436%. The return of the FXI, the China ETF, well, you can see it. So this is the problem. So I don't have a solution, but you got to do, I guess I do have a solution, but you got to get more targeted and do what the Ivy League endowments did. So the first half of my emerging market life, we launched these China ETFs with Guggenheim, but I spent most of my time in New York and Boston with families, endowments, foundations like Harvard's. I watched them double their allocations, but then they would get more targeted. And if you're, David Swenson managing the Yale endowment, you could take your smartest Chinese alumni and start a private equity fund in Shanghai, which they did. It worked very well, but most people couldn't do that. And so when people would call me, because they knew what I did, and say, what's the best emerging markets ETF? I said, that's easy. Just buy the emerging market consumer ETF. Leave out all the banks, leave out all the oil, all the corruption, and just go right to the tip of the spear. It's the people that are emerging. So let's get a whole, let's invest in that. And 10 years ago, I got a call one day. I was in my car and my iPhone, my first iPhone, was sitting on my car seat next to me. And I answered the phone and my friend said, what's the best emerging markets ETF for long-term investors? And I started to tell them the same thing I told everybody that asked me that question: buy the emerging market consumer ETF, which I didn't have anything to do with, by the way. It was launched by a whole totally different firm I didn't even know. But that's what I told people to buy. But when I got that call, I had a light bulb moment. And I went, wait a minute. That's not the answer anymore. And I got off the phone. I went straight back to my desk, and EMQQ launched 100 days later on the New York Stock Exchange. So here's what EMQQ is. It wasn't as clear to me then as it is now, but it is a combination of three big things, so-called mega trends happening at the same time all over the world and creating what might be the fastest growing sector the world has ever seen. And the problem, or one of the problems, not the right word for it, we are part of all three of these trends, but we've been part of them for generations. So we don't really think about them as trends. What are these three mega trends? Well, we've already covered the first one, right? I can't speak for anybody else on the phone, but my family, when I was a kid, we had cars and vacations and went to college, at least my brothers and I, the first to do that. But, we've been doing these things for a long time. Well, guess what? Most of the world's just getting there. They're just now getting the disposable income to buy more food, better food, more protein, go to a movie, get on an airplane for the first time. These things are just arriving to the 6.5 billion people in the developing world. Now, as I mentioned, when I got that call, it was on my iPhone. So I had an iPhone 10 years ago, but it was pretty new. I'd only had it for a couple of years, but I had a computer for 20 years before that. So most of the emerging markets are getting their first computer today. And it's not a desktop computer, and it doesn't have an Apple logo. It's an Android-based smartphone that's getting better and more affordable every year. You can now buy a brand new smartphone in India for $12, which I'll talk about. So the second trend here is the computer, and the third one's called the internet. I got the internet in 1995 on Cervantes Street in the Marina District of San Francisco on a telephone line with a modem. Now it's gotten better and faster, and I can even get it on airplanes now. But guess what? Most of the world never got wired. So you're taking 6.5 billion new consumers. You're giving them pocket-sized supercomputers and access to high-speed internet for the first time. And they don't have all the infrastructure that we have. This is going from 0 to 100. They don't have a bank account, credit card, debit card. They almost certainly don't have a car. There's probably not a Target store. So these people are leapfrogging, and the result has been this: what I believe might be the fastest growing sector ever. Now, I'm not 100% sure of anything in the world, certainly not with investing. But when I launched in 2014, I had this same chart, but I only had these first 5 bars. And I offered a ham sandwich to anybody at the CFA Society that could show me a sector that ever grew like that. Now, I've increased my reward over the years, and I still haven't had anybody send me an email challenging this as the fastest growing sector. I've asked Burton if he can think of any sector that ever did this, and he's been teaching economics in the Ivy League for over 60 years, and he doesn't have any recollection of this ever happening before. So either way, the result of this great confluence, these 3 megatrends, is significant, massive growth. Now, importantly, this has largely been China so far. Alibaba and Tencent, I'm sure most of you know these two giants that have digitized all of China. And so the reality is this has really been a China story so far, but there's something else coming right behind China called the third wave. Because if we look at China, yes, it's an emerging market in a traditional sense, but when it comes to smartphones, when it comes to e-commerce, when it comes to technology, China's the most developed country on the planet by a mile. It's not even close. China is the Jetsons. Look at their e-commerce market. Not only does it dwarf the United States, it's 4 times bigger than every other emerging market combined. So China stands alone. Now let's look at that same revenue I showed you before. This time, China's in gold. The other 45 emerging and frontier markets in purple. There's 4 times as many people in the purple. China, again, very well developed. You saw what happened. So yes, now it's 25% of all commerce. Well, everybody else is in the first inning at 5% population weighted. So 4 times as many people first inning. This purple revenue, I'll bet you a ham sandwich, it's going to go up 10x and probably 20x. And my best research is I've never met anybody that used to have a smartphone. And these people haven't even gotten theirs yet, 3 billion of them. But with prices now below $20, you can bet that they all will at some point. So this is what we call the third wave. The first internet wave. When did millions of human beings first have a personal computer and access to the internet and a browser that they could open and go to a website and actually buy something or sell something? I'm sure I did that before most people because of where I lived and what I did. But let's just say that started in the year 2000. And what happened? FANG stocks took over our lives and our stock market. First on PCs, then on smartphones. That was the first wave. Second wave was China, starting right behind us, 2005 to 2020. Baidu went public before Google did. So that was the second wave. You saw what that created. Well, now we have this third wave, and the third wave is where most of the world's people are, and India is the biggest part of that. Now, for most of my life with EMQQ, I didn't have any Indian exposure. It wasn't possible. There was only 2 publicly traded Indian internet companies. And so when we launched, we were 60% in China and 0.5% in India. And as recently as 2020, we were 60% in China and 0.5% in India. But miraculously, during the COVID, India managed to do 25 IPOs of their internet companies. We knew they had a big pipeline. And during the COVID, they did 25 IPOs, all of them in India. So you didn't probably hear or see much about them. And now, because I didn't have a lot of India exposure, I've had this coming soon slide for a long time, right? Okay, we don't have a lot of Indian holdings, but it's a democracy, and a lot of people don't like communism. They think that China's evil because of that. But I said, well, we've got this big democracy in India coming, and the good news is they're embracing technology. So But finally, India arrived, and now our different strategies have a lot more India. And in fact, the India story was so compelling that we launched INQQ, the India-only strategy. So this is posed as a question: is India the perfect emerging market? But it's not a question. It's basically, it's not deniable. And let me show you why India is the perfect emerging market. We go back to the checklist. Why are we here in emerging markets? They have got a lot of people. They're young. They're fast growing. That's driving consumption. If that's the checklist, it's not even, not only is it the perfect emerging market, there's nothing even close at this point, and there can't be. So India, we're looking first for a lot of people. Well, okay, who's got the most people? India. India passed China a year ago, and as you can see, going out into the future, India is going to grow and keep growing because it's young. China's demographics look European, and it will not be number one again in any of our lifetimes. And every day, India sets a record as the biggest country ever. Today, it set a record. Tomorrow, it'll set a record. Every day until I'm dead, it's going to set a record as the largest population the world's ever seen. Now, if we put this in perspective and leave out China, India is bigger than everything else combined. Indonesia is number 2. So this can't happen again. So check the box, exclamation point. Yes, a lot of people. Young people, check the box. It not only is it big, this is just one simple way to look at demographics. There's a lot of other nuanced ways, but from a just sheer number standpoint, India has twice as many people under the age of 30 as the entire US population. Fastest growing economy. It's not only is it the fastest, it might be accelerating. If any of you have paid attention, the estimates for India remain 6.5% for this year and next year. The last 3 quarters, they posted 7% plus, 7% plus, and 8.4%, almost 2 points faster than the estimate. I think the estimates are going to go up. So yes, it not only fast growing, fastest. And what's that driving? The same thing we saw in China, a middle class of consumers that now can afford stuff, and they want stuff, and they're getting stuff. And when you put all these numbers together, the OECD says India is not just going to pass China, but in 25 years, it's going to be considerably larger. So if those are the things you're looking for, this is the perfect emerging market, and it can't happen again. So why? Okay, well, why is it happening now? What has it been waiting for? Where was it? I'm sure a lot of you have seen that India is getting a lot more coverage in the media, especially in the investment media. The simple reason, the simple answer is Modi, the leader of the country, Prime Minister Modi. He is the Deng Xiaoping of India. He is unleashing, just as Deng unleashed capitalism and free markets in China, so too is Modi doing that for India. Now, they have a different background and backstory about how they got here, but Modi is running the country like a business itself. And he's cutting out all sorts of red tape, simplifying the tax code, and doing everything he can to end or at least cut back the damage of the bureaucracy that they've inherited from the British and from the socialist leanings they had in their first decades as an independent country. So he is running the country like a business. Now, he's just completed his second 5-year term. They've started voting a couple of weeks ago. The voting will end on the 4th of June. He will all but certainly be the prime minister again for 5 more years. So they'd have no term limits. And he's 10 years younger than either of our candidates, unfortunately, or fortunately for India. And he has an incredible approval rating. And he's not only running the country like a business, he's finally invested in the infrastructure. When I got involved with China 20 years ago, they were neck and neck in terms of basically all of their GDP numbers. But what you saw every year was China pulled away because they were building the world's greatest infrastructure so they could make products and move them around and get them on a boat and sell them to the world. And meanwhile, with the bureaucracy that India has, they couldn't even get the power to work. They had terrible problems with brownouts and factories having to stay shuttered because the power was inconsistent. So finally, under Modi, they have basically doubled the infrastructure in 10 years. Every mode has been seriously invested in, and they're not done. It includes modernizing the extensive train tracks and electrifying them. They're mostly done with the electrification, new stations, their own homemade high-speed trains, hundreds of which will roll onto the tracks in the coming years, connecting the cities. This looks just like Shanghai on my first trip. The number of airports will triple. Buying that $29 plane ticket to go to Agra or some other place is going to be a huge business. Again, they're going to triple the number of airports, and they're going to need more seaports if they're going to get jobs from China. And they are going to get jobs from China as people seek to diversify their manufacturing. Apple, as an example, will make as much as a quarter of their iPhones in India by the end of next year. So now here's where India, not only do you have all of the fundamental things you need, size, youth, fast growth, consumption, you have a democratic-led government focused on running the place like a business, and you also have this incredible human capital. You have a technology sector in India that's older than I am. Tata Computer Systems, as it was originally called, was born the year before I was born. So this is a very important advantage. You have publicly traded technology companies. They've been public for decades, billionaire founders, an ecosystem of technologists, of venture investors, of angel investors, millions of employees and former employees. You have an incredible educational system with 23 institutes of technology, some of which might be harder to get into than Harvard. And if a lot of them do get into Harvard and our other best schools. The deans at half of the world's best business schools are Indian. There are 25 S&P 500 companies that have Indian CEOs, including Google and Microsoft, both of whose CEOs went to the institutes in India, and came over as temporary work visa holders. So you're not going to find this in Indonesia. You're not going to find this in Vietnam. You're not going to find this in Brazil. India has an unmatched talent pool of technologists and management skills, and they're increasingly seeing their opportunity isn't to come and work for a US company, but to stay and build India. Now, here's the final thing I want to tell you about with India, and this might be the most important part. And so now's the time to pay attention or take notes. When I talk to investors right now, and that's all I do basically, and the last month I've spoken to well over 100 investors, both here in the US and a couple of weeks in Europe. And these are, professional investors mainly. And what they tell me about India right now, they say to me, yeah, India looks really good. And then they say, but it's really expensive. The stock market's really expensive. That's what, almost every single person says to me the exact same thing. India looks good. We're bullish on India. Little worried about the valuation. So what I'm going to tell you is that India is better than they think. And it's because of this last part, the India stack. And I'll also show you why, I don't think it's expensive, but I'll show you the numbers and you can tell me what you think of them. But let's start with why it's better than people think. So 99.9% of the people I've referenced, those professional investors in Europe and in the United States, none of them know about this, or they don't really know about this. They know about it after they talk to me, but this is something that is a real secret weapon. It's called the India Stack, and what it is digital public infrastructure. Now, normally when I'm in an in-person meeting, I'll ask who I'm talking to if they can name a piece of digital public infrastructure in their own lives. And that also has resulted in 99.9% of the people not being able to answer that question. Everybody uses digital public infrastructure, including right now, everybody on this call. The best examples of digital public infrastructure are called the internet and GPS. I didn't make the internet. Now, some of you on the call might have made the internet, but I didn't make it. And I didn't make GPS either, but some of you on the call might have been involved. But either way, these are digital things. They're basically free, and they serve as plumbing for the digital life we live today. So those are the best examples of digital public infrastructure. The India stack is what is India's homemade proprietary digital public infrastructure. And the reason it's called the stack is because if you wanted to make a picture of it, it looks like this. Now, this is a very simplistic view of this India stack. There's other layers that have been introduced or soon to be introduced, but I'm just going to cover these three, and I'm going to start from the bottom. The bottom, the first piece of digital public infrastructure is called Aadhaar, and it was launched in 2010. Now, Aadhaar is the Hindi word for foundation. So the foundation of the stack is called foundation. And the hero of the story is this man here. This is Nandan Nilekani. Nandan is one of the founders of Infosys. He is a multi-billionaire. He is the chairman of the board of Infosys today. And let me tell you how this whole thing started. In 2009, the government of India approached Nandan and said that they wanted to start a national identity card system that would give everybody in the country a physical identity card, kind of like a driver's license, with your picture, your information, and everybody would get their own 12-digit number, like a social security number. And now this was something they had talked about for many years, because one of India's real challenges in modernizing was that people lacked identification. Only about 40% of the babies even got a birth certificate. You had a whole lot of people that said their birthday was January 1st because there wasn't good record keeping. So as you can imagine, it's hard to modernize an economy with that backdrop. And so they decided in 2009 that government was going to set up this entity that would create a national identity card for everybody in the country. They asked this man to be in charge. And Nandan said, I'll be in charge of this program, but if I'm going to be in charge, I'm going to be in charge. And not only are we going to give everybody a physical card, but we're going to use a lot more technology than you people in the government are used to. And we will link every single card and every single number to a human being with a scan of their eyes and their fingers. Biometric information, a biometric ID system, a physical card, like a driver's license to put in your wallet, but also the ability to link that to a number. Now, when they launched this, I thought, great. I added the logo to my slide about India coming soon, but I didn't really pay attention over the last, I didn't pay attention to this until 2 years ago. Now, and one of the things that I didn't remember about this platform was that in 2014, 4 years after they launched it, they added a program where anybody that was in the system, if you had registered in the Aadhaar system, you could walk into a bank and open a bank account in 2 minutes with no paper. I didn't know about that. Let me show you what's happened. By the way, this was all voluntary. Nobody was required to register. It was only in 2022 that I realized that this system had been deployed across the entire population. And 95% of the people are now in the database, and 800 million of them have opened a digital bank account. So you've taken 800 million people whose entire financial life, the way they paid for everything was paper. Okay? They were not included in the financial system. They didn't have a bank account. You've taken almost 1 billion of them and In 2 minutes, each of them have opened their first bank account, and it's digital. I didn't know that until 2 years ago. Now, 2016 is the year where the hockey stick formation for digital India started. And nobody knew, it wasn't like a plan, but it just happened in a sequence that it was the big bang for this story. And it starts on April 4th, 2016, when Aadhaar passed 1 billion people. Because a week later, they introduced the second layer of the stack, the payments layer, called UPI, which stands for Unified Payments Interface. Now, I got to be honest with you, when they launched this, it got a lot of hype, and I didn't understand it. I kept looking around like, why are we hyping this? It's QR code-based payments. Like, that's not cutting edge. If you've been to Brazil, you'd have seen that Mercado Libre, the Amazon.com of Brazil, had coded the country in QR codes. Of course, if you went to China, everything had a QR code on it from either Tencent or Alibaba. So this wasn't revolutionary, at least as far as I could tell, but it got a lot of press. And QR code-based payments, the Unified Payments Interface, introduced again by Nandan Nilekani and his team. And I didn't really pay attention after that because it didn't seem that important. It seemed good, but it didn't seem to be as important as the news made it sound. What I didn't pay attention to was the last line on this slide. This isn't me walking into 7-Eleven with my iPhone and putting something on my Amex card. This is instantaneous transfer of my cash into your account instantly with zero cost or friction. And you could send me 1,000 rupees and I could send it back to you, and we could do that 1 billion times. It would still be 1,000 rupees. I didn't pay attention to that. So you'll see in a moment what has transpired with this UPI payments layer. So again, pass 1 billion people in the database, 800 million digital bank accounts. Week later, they add the second layer, the payments layer. Now, 4 months later, something happened that wasn't part of the stack, but it kind of is. It was the launch of Jio Digital and the first 4G mobile network in India. In 2016, there was a highly fragmented mobile carrier market. There was 12 different phone companies. Every one of them was on 2G, and they were all suffering from an endless price war. Mukesh Ambani, the chairman of Reliance Industries, comes in with $25 billion, buys the 4G airwaves, builds a brand new state-of-the-art physical network covering the country in 4G with readiness for 5G and 6G. Now, when they launched in September, they had an ambitious goal. They wanted to get 100 million people in the first year. And their offer was pretty compelling. They had the only 4G network. And if you had one of the new smartphones, you probably wanted that. They gave away unlimited free voice calls forever and 6 months of unlimited free data. And they offered to have the lowest cost data in the country after your free trial was over. Now, it seemed ambitious to sign up that many people because the average time to get a new phone in India back then was about 3 hours. If you went into the Vodafone store or the Airtel store, it took about 3 hours to process you. The entire India stack has open APIs. Reliance used the KYC functionality of Aadhaar and signed up 100 million people in 100 days. And they took that 3-hour cycle, then cut it down to less than 5 minutes. So this was the first sort of aha of the power of the stack, not just for the government to do things, but also for private enterprise. Now, the entire country is on 5G as of last September, thanks to Jio. And not only do they have low data costs, they have the lowest data cost on the planet. In the upper left, we pay 50 times as much for a gigabyte. And as you see on the far right, they're using more data than anybody else on the planet. Now, in quick succession after the launch of Geo, very controversially, Modi took out all the large denomination currency out of circulation. Had to bring it to the bank and turned it in. This was predicted to do all sorts of damage to the Indian economy. It did have some short-term impacts, but this was an important move. And then in the beginning of 2017, they finally, I won't go into the details, but their tax system was definitely holding them back. They simplified the thing as simple as they could make it with a goods and service tax, or as Modi calls it, a good and simple tax. And watch what happened after that. In black here is the UPI volumes. That's 13 billion in the most recent month. That represents 50% of the entire planet's instant payments. The slope is growing at 55%. Only 20% of Indians are using it so far. So this is digitization, unlike at a rate of growth that has probably not been seen before. And behind this, the entire Indian economy, which 7 years ago was 95% paper, nobody paying their taxes, all sorts of hidden money. And in 7 years, you've made it 80% digitized. People are paying their taxes. In fact, every single tax return in India now is digital. And the tax revenues are exploding. They're growing faster than the GDP that's funding the infrastructure. So this India stack, I'll go back to the picture of it. This is a secret weapon that no other country has, and they're not done. This top layer, which I won't go into, is an e-commerce layer that's going to hypercharge the digitization of the 13 million mom and pop stores, which is just launching. There's a credit layer. Now that everybody has a digital financial footprint, well, guess what? You can create your own credit score, or at least release your data to credit providers in hopes of getting a loan. And that alone should add meaningfully to the GDP growth numbers. So this is something that is not well understood, and I think it is incredibly, incredibly powerful. And again, there is no country on the planet that has this digital public infrastructure, and they're not done. So now let me move to the end here. So, a lot of the way that we've thought about this is, how does this look versus when we first got involved with China? And remember, I told you the China ETF, it didn't do very well if you went back that way. But there's a lot of anecdotal things that look like China 15 years ago. In my second trip to Beijing, I visited this Apple store in the Sunderland Mall, which was brand new. And a week after I left Bombay last year, they opened the first Apple store there, and a week later, the first one in Delhi. So it's kind of like Apple, or kind of like China 15 years ago. The GDP numbers were almost identical 18 years ago, but 15 years ago, you can see they were pretty close. But if you look at the very bottom line, there's an asterisk, because nobody on the planet had a smartphone 15 years ago. And so what makes this India story so compelling is it's where China was 15 years ago in a lot of ways, but the art of personal consumer technology is at a point where you can now get a pocket-sized supercomputer for $12. And you have this genius man and his colleagues that have built this incredible digital platform. And as Burton would say, there's no antecedent for this. This hasn't happened before. The combination of things, the nonlinear structural changes to the economy and digitization, and there are multiple virtuous cycles happening within this India story, and I think it is going to be a very big thing. Now, let's talk about what we do and why we think it's the way to go. So we have this INQQ strategy, which is just the Indian internet sector, which is today 25 stocks. I suspect there will be at least that many IPOs in the next couple of years, and eventually we might have 100 Indian internet companies, but now there's 25. And what we're trying to capture is this. India's economy is going to grow. It's going to grow a lot. This chart shows it basically doubling in 8 years, ending in 2030. But the Indian internet economy is going to grow at, well, a whole lot more than that. So what are the businesses? So most of these things, you probably have a version of it on your phone. The leading travel app. Now, this is a company that is unique in a couple of ways. First of all, it's one of the only ones that trades in the United States. And it's one of the only ones that was public when we launched. So this was a day one holding for our main fund, EMQQ. And of course, it's a big part of INQQ. If you want a plane ticket or an airline ticket or hotel room, I've used it myself. Make my trip. This is the other company we've owned from the beginning. This is InfoEdge. And they have two primary assets. The first is the leading job site for Indians, and the second is, why am I blanking? Sorry, I'm having a brain freeze. It'll come back to me. Jobs in real estate, of course. So if you want to sell a house or get a job, that's the company that owns the websites for that. InfoEdge. And this company throws off so much profit that it's also invested in 20 other Indian internet companies, including Zomato, the DoorDash of India. Now, for a lot of reasons, when I talk to people, I'll use a shorthand description like the DoorDash of India, the Amazon of Brazil. And that's helpful in getting directionally an understanding of these businesses. But in every one of these sectors, whether it's insurance, beauty products, food delivery, the per capita numbers are so small that the size of this opportunity relative to more developed economies is massive. And so Zomato, the food delivery leader, it has an opportunity to basically become an operating system for the future of eating food in India. And as evidence of that, their fastest growing business isn't delivering food, it's selling restaurant supplies to the restaurants. So again, an opportunity set that's a lot different than DoorDash. When DoorDash showed up, of course, we had a very well-developed restaurant industry. Another company that InfoEdge helped invest or did invest in early, Policy Bazaar, online insurance, dominant market share, pretty straightforward. Online beauty products. This is like the Sephora of India. They actually have the big, beautiful anchor stores as well now, but the app and the site, most of the revenue, founded by an investment banker. This woman in the corner, she promised herself she'd become an entrepreneur before she turned 50, and she did. And now she's a billionaire and one of two self-made women billionaire in India. Online gaming, of course, cricket, and finally payments. And this company has been in my presentation for about 8 years. It's only been public for 2. The reason I featured it is because Berkshire Hathaway, my heroes, and Alibaba were both early investors in this payments company. And now this company went public in November 2021 at the very top of what is, in hindsight now, very clearly an Indian internet bubble. So this stock top ticked. And now a year ago, I did 3 different CFA presentations in India. And one of the things that I heard in every meeting when we got to the Q&A, a young Indian person would say, why would I invest in these Indian internet companies? Why would I invest in Paytm? These are terrible stocks to invest in. And the second thing they said was, Indian internet companies don't know how to make any money. They're just a bunch of young kids that have no idea what they're doing, and they've just had a lot of venture capital thrown at them, and now they're just, they're aimlessly growing just to grow. So those were the 2 things that everybody said. Now, why did they say the Indian internet companies were a bad investment? Well, because they were. They had a bubble. And that bubble was painful, and it drove the valuation of a lot of these things down a lot. Now, I thought it was short-sighted for a 28-year-old to give up on his internet companies. And obviously, a decline like that's not fun. But if you're a long-term investor, you should applaud those if you think that the fundamental story remains intact. So they all told me the internet stocks were a bad investment. Now, by the way, I should mention we missed most of the decline, but we still have a negative track record, even though we're up 40% the last year, because that knife was falling. And even though it was already falling when we launched, we still took a big step into a bucket in terms of our performance. Fortunately, we didn't really have any investors until last year. And while these people seem to indicate these were not profitable companies, that's not true. I think they all read the same book about Flipkart, which is an unprofitable internet giant in India that Walmart controls. But the companies that are public that we own, not only are they profitable, other than Paytm, they have world-class margins. 28% operating margins is pretty good for a company, let alone a sector. Now, okay, everyone says India is expensive. I told you, all these investors I talked to told me that. If you look at this chart, yes, it's got a higher PE ratio than the S&P and higher than other emerging markets, but it's also perhaps the best emerging market ever. But the PE doesn't mean anything to me without the G, because you're buying the future. The slope of the growth of the E is just as important as the PE itself. And so people tell me that India is really expensive, and I think there is some speculation going on in the micro cap part of the market, but in terms of the broad, large index, that 120 stock MSCI, I don't know. Do you think a PEG ratio of 1.2 is bad? Would Peter Lynch tell you that's a high PEG ratio? So I don't see it. And the internet companies actually may have a PEG ratio even lower than the broad indexes. So let's talk about the risk quickly. India has key man risk more than any other entity on the planet. Modi is the embodiment of this India miracle, and they need him. Again, he's almost certain to get elected again on the 4th of June. He's relatively young. He takes good care of himself. And but you know, people get hit by lightning, or sharks eat them, or all sorts of other things can happen to people. They have a lot of religious tension and other ethnic tensions that are constantly happening in some part of the country. In the Northeast, in Manipur right now, you've got a Christian group and a Muslim group that are battling, and in the Punjab, the Sikhs are always trying to get their own country. Those things are real. They need jobs. They have a lot of unemployed, educated young people, and they need jobs. They need manufacturing jobs. Now, the good news is they know that. They're doing everything they can to lure businesses. They've set up this new sort of a free trade zone, the Gift City, to help make it easier for international companies to come to India. So, and there's also the forces pushing things out of China, so that should help as well. But they need to do it until they got the jobs. That's still a risk. A big disparity, like everywhere, between rich and poor. Climate problems that are very acute, including heat and smog along the Ganges and flooding in the southeast. And there's always corporate governance risk when you're in emerging markets. So, but why INQQ and why India? Well, this is, you know, it's hard to argue it's not the perfect emerging market. If you make the checklist of everything you want, a lot of people, young people, fast growth, consumption, it is number one, and it can't happen again. And you add in a democracy that's building the physical foundation needed. You add in this incredible talent pool of technologists and management that have proven themselves to the point where they're leading a large percent of the S&P 500 companies, including our biggest tech companies. And you add this digital secret weapon, the stack that I talked about. You also have a very tense world situation with different wars and battles going on. And India finds itself, or has put itself, in a very neutral position, or as Modi says, where they're not neutral, they're on the side of peace. They can buy oil from Russia and still have dinner at the White House. And in spite of everyone telling me the valuations are outrageous, I don't think that's true. So now, how do I think about what we've got here? What we do is for long-term investors, and our simplest goal is to give you a return that's better than just buying the traditional index. Everything we do can be and has been volatile. As I mentioned, INQQ was down 50% almost immediately. Now, luckily, I think I was the only investor, but we did have a big decline in the beginning of this, and I'm sure we will again. I'm sure we will again. Hopefully, we'll make some more positive progress before our next correction. I don't make short-term predictions about anything in the stock market. I have no idea whether India's stocks or US stocks or any other stocks are going up this year, next year, or the year after that. I'm very simple and Omaha about this. Earnings equals value. The way to grow your earnings is to grow your value. And the whole thing starts with revenue. And so I'm quite confident that this group of companies is going to enjoy very fast revenue. And with their current profit margins, I think investors will do, and current valuations, I think long-term investors can do quite well in this. So that's the end of my presentation. I'm sorry if I went a little over the clock, but I'm happy to stay and answer questions as you have them.
Celia, do you want me or do you want to handle the questions?
Feel free, Deborah.
Okay, the first question was early in the presentation. What was the reason for that? Is that there were no other private companies then, Alibaba, etc.?
I don't know that I understood the question exactly.
Given the context was that you had mentioned earlier that those initial ETFs did not have, they only had those state-owned companies, right? So I was just wondering what's the reason for that.
Well, the broad indexes have always had state-owned enterprises, and they've always been a large part. And the indexes weren't required to have them; they just did. One of the things I realized in emerging markets is that part of the problem is that because indexing is driving a bigger and bigger part of the investment business for obvious reasons, and of course, my partner Burton was involved with starting indexing. But when it comes to emerging markets, I think that people should have the indexing people should have been more thoughtful at the beginning about how they did this, because nobody would invest in the S&P 500 if it was full of government-owned banks and oil companies. Now, we don't have those types of entities, certainly not the way emerging markets do. So now there has been an emerging markets ex-China ETF created. In fact, I think I'm the best salesperson for it, because before the Wisdom Tree people launched it, I talked about it for 10 years. So there is a emerging markets fund that you can buy that leaves out state-owned enterprises, and that's definitely better than buying the traditional one. But I think that's hopefully answers the question.
Yeah, thanks.
Kevin, do you invest in Indian ADRs or directly in the Indian stock market?
There are only, I want to say, 2 ADRs, and the rest of them trade in India. So they trade on the NSE or the National Stock Exchange or the Bombay Stock Exchange. It's actually very hard to trade in India. That's one thing that, it's easy to buy Chinese companies in the US. It's easy to buy stocks in Hong Kong, and you can do that at Schwab and other places. Now, you cannot invest in India. It's literally a US citizen would not be able to open an account and buy a stock on the Indian stock exchanges.
Is INDA ETF a viable trading vehicle?
Well, if you mean trading is in speculating trading, sure, I guess it's liquid and tracks the MSCI index. The MSCI index, which is what INDA tracks, it's about 10% state-owned enterprises. So it's not as bad as the China ETF was, not even close. And actually, this is, by the way, this has never happened in the history, by the way, but it looks like India might actually turn their SOEs into more pure capitalist endeavors, which that has not occurred before. But the Indian SOE stocks have actually been great performers recently because there's a belief now that they're going to actually privatize them in a way that really does maximize shareholder value, which again is not happened in an emerging market as far as I remember. But the biggest problem with INDA is that Infosys, Tata, those tech companies that I mentioned in India, they are very big. And about 20% of INDA is in those companies. And they're fantastic companies. They're very important companies, but they don't get any revenue from India. They get all their revenue from the United States. So, and they're not growing. If you look at the last quarter, the big four tech companies, which again, what they're doing is exporting technology services to the United States. So their revenue is not growing. They had 0.0, they had less than 0.5% revenue growth in the fourth quarter. So that's the biggest problem with the INDA, is that the largest companies don't even have exposure to the growth of India. They have exposure to the Fortune 500. So it's okay, I would say, but I think, I'm obviously biased, but I think INQQ and the tech focused sector is the way to go long term, as we've seen in other parts of the world like the United States.
I'm concerned about the destabilizing effects of climate change on the subcontinent, including India. Won't it be disastrous for economic growth over the next 2 decades?
Well, I hope not. I think the world has a lot of climate risk, and I do, as I mentioned in my slide, I think India's got a relatively acute climate risk because of two reasons. The southeast of the country, which sort of surrounds Bangladesh, that whole region, the Bengal region, is always wet, and it's always 30% flooded, and it's even been as much as 50% flooded recently. So the rising sea levels could be a problem. And then along the Ganges River, they have this, it's become quote unquote uninhabitable at some points in the summer where the temperatures reach 130 and there's horrible pollution. So absolutely the climate risk is a risk to places, and I think the South Asia definitely maybe more so than the average. Now, having said that, I'll quote Modi and say, pessimism has a short shelf life, and optimism is eternal. So, hope for the best.
I assume the next is a question. UPI taking transactions from Visa and MasterCard?
So it's a question, can Visa and MasterCard operate on I don't know the answer to that question. I think it's taking serious market share from Visa. My colleague was at a Indian investment conference a couple of weeks ago, and he summarized some of the main presentations, and one of them was about Visa being very scared or frightened by what was going on with the UPI. But I can't speak to the functionality of, if the question was, can I use my Visa on the UPI? I don't know the answer to that.
The next one was a link for a recommended read. You may find the reforms to the real estate sector, RERA, interesting reading. So if someone wants to look at that, you can look at the chat or download the chat.
Oh, I want to see that. I think there's definitely, reason to think that Indian real estate. I think the Indian real estate market's got a high chance of doing very well for long-term investors as well, but it's not clear to me yet that there's many opportunities for U.S. investors to participate in that.
Is inflation a concern?
Yes, inflation's a concern in a lot of places around the world, and I think they've got it kind of tamed in India, but especially in poor countries, it's the food inflation's the killer, right? If you're making $1,500 a year, $2,000 a year, and $3,000 a year, but a large percentage of your money is going to food, and if food prices go up 20%, I mean, they can turn you into put you in the red. So I think that's the main risk, the main inflationary risk that India has. It's been relatively stable the last couple of quarters.
Are the higher interest rates holding back India's economy? When the Fed finally starts cutting, will that serve as a catalyst for India's market?
It could. I know that historically there's a pretty high correlation between those U.S. rates going down and emerging market stocks going up, but I don't make predictions about stuff like that. But I think that the from a broader standpoint, I mean the risk-free rate, the U.S. government bond rate, I mean that's the benchmark for everything. So if any risk asset should theoretically be more attractive if the risk-free rate goes down.
How does the India payment stack firm make money if they don't charge fees?
It's all not for profit. It's there. I don't know the exact structures, but they're the UPI is owned by a consortium of banks and operates as a nonprofit. I think is the simplest way to put it.
So some government funding, maybe?
Oh, I think there was definitely some initial government funding, yes.
Do you have analysts in India for IMQQ?
No, not yet, but I've got a whole lot of Indian investor friends that we constantly are learning from, but both in India and not in India. I have one of the things that I've been very fortunate about is that over the last 10 years, I've developed a professional and personal friendship with a handful of different Indian men that have all been very, very successful. They're all my age or older, most older, and they all went to school in India. And then they went to Wharton, a couple of them, and other schools. And then they had very successful careers in private equity and venture capital and hedge funds and Wall Street. And I've learned a lot from them. And I am able to get, I think, very good, to the extent I need any important information, they're pretty good at giving me what I need in terms of knowledge gaps I might find myself facing. So, but we don't have any analysts on the ground right now.
I believe that's all the questions in chat.
Okay. Well, let me just say this then. Thank you very much for having me. I appreciate everyone that tuned in, and certainly thank you two for hosting and organizing. And please, if you're interested, reach out to me, connect with me on LinkedIn if you are a LinkedIn person, or send an email. And if you have follow-up questions or comments, please don't hold back on sending those. If you think you have a friend that would be interested in this, tell them. And we're always here, and we'll hope to hear from some of you.
Good, thank you. Go ahead.
For those who'd like to download the chat, there's normally 3 dots probably at the top of chat that if you hover on or right click, you should be able to get a menu. Okay, left click now to save the chat.
Good, Captain, thank you very much for presenting.
By the way, I didn't know that, Deborah. Now I just learned something myself. Thank you. I just saved my first chat.
Yeah, some of the best information in these presentations is in the chat, actually. So thank you, Kevin. It was enlightening and very interesting. I'll make one comment generally for Silicon Valley. We're enormously grateful for the brilliant engineers and managers from India that make Silicon Valley run much better and are a real benefit to us. So I'll just do a shout out and thanks for that. And this program will be available in about a week or so, depending on how soon we get it, all the editing done to be available. And I remind everybody that September 14th is our next program. And I wish everybody a great rest of the day. And thanks to all those that came and listened and shared and asked the questions.
For those that are logged in or registered, and when the link for the recording is available, I email out the link.